kind of stuck with a pretty consistent asset mix to where we finished off the second quarter, and frankly where we moved at the beginning of the year. The beginning of the year we did reduce equities to equal weight, bonds remain underweight, and cash somewhat overweight. And that's a structure that we've maintained for the third quarter. We do think that the worst of the tariff uncertainty is behind us, but we think that the markets might be underappreciating the extent to which tariff realities come through in the coming few months. And so that's why we're maintaining a hold at this time on equities, coupled with the fact that we've seen sentiment become fairly elevated. Liquidity conditions may tighten a little bit here. And so as a consequence, we think it might be a little bit premature to upgrade equities. They've had a good run the last few months. Year to date, still kind of low, mid, upper single digits, depending on which market you look at. And it felt from our perspective like a neutral stance made the most sense. And we're a little bit more concerned on the inflation side of things, and therefore maintaining a little bit of an underweight to the fixed income part of the market. The primary adjustments that we made on the country framework side of things were to reduce the U.S. to an equal weight. We still think that the U.S. has a lot of advantages, but we are concerned that some of these tariff impacts may still not have fully played out. There could be some uncertainty around some of the questioning of the status of the Fed by the Trump administration, which could weigh on it a little bit. And the passage of the One Big Beautiful Bill Act does help support activity going forward, so we view that as a medium-term favorable. But in the meantime, that means that they can resume issuance of bonds, and that could drain some liquidity from the system. We also are structurally somewhat more concerned about the US dollar. It's kind of overdone here in our view, the weakness, but it could over the medium term still be a bit of a challenge. We might get a bit of a counter trend rally there, but medium term we're a little bit concerned about that. Offset that, one of the beneficiaries of a somewhat weaker dollar over time should be the emerging markets, and we're seeing far more stimulus and better liquidity conditions out of the likes of China. And as a consequence, we upgraded emerging markets to a neutral stance as we downgraded the US to a neutral stance. We're still maintaining a modest underweight to fixed income. It's kind of on a relative basis. Fixed income expectations from our end remain kind of a mid-single digit return over the course of the year, and we're on track for that. So they're not doing that badly, but we do think relatively speaking, equities look somewhat more attractive, hence the neutral to equities versus a bit of an underweight on the fixed income side of things. Credit spreads are fairly tight here, so we did reduce our exposure last quarter to that area, and we're kind of holding at these levels here. And where we're slightly concerned is the potential for a little bit of inflation. And more importantly, there are concerns around deficits rising around the world, not just the US, also Japan, Europe, the UK. And all of that is potentially weighing on the longer end of the bond market. First, and I'd say most importantly, it represents optionality. So we will have the means available to deploy that cash into one of the other categories that at a point in time that we feel it becomes more attractive. So that's the primary consideration. Secondarily, cash is still paying a reasonable amount. Now we've seen overnight rates come off the peaks over the last couple of years to some extent, but you're still getting T-bill returns that are in the mid to upper twos in Canada, somewhat higher in some other jurisdictions. And so you're still getting paid to wait a little bit.